America is trying to change the rules in the gold and cryptocurrency markets. They have a $35 trillion currency debt. They move it into crypto, into the cloud, devalue it, and start from scratch.
The US government has a problem. For decades, the status of the US dollar as a global reserve currency has given the United States tremendous privilege. It's allowed the government to finance its massive debt pile at very low interest rates and to run persistent trade and fiscal deficits with, so far, very little consequence. But this privilege is showing signs of disappearing. The US dollar's share of foreign exchange reserves has just hit the lowest level in 30 years. The US government's interest rates are now hovering at around the highest levels of the last 20 years, breaking out of what had been until very recently an extremely steady downtrend. As a result, we've seen the US government's interest payments on the debt go from $500 million to $1.2 billion in just 5 years' time. So just interest payments are now equivalent to now over a fifth of the government's total revenues. This is a phenomenon that the European Central Bank has labeled as the debt doom loop, where the loss of confidence in a national debt leads to higher interest rates, which leads to budget problems, which in turn further impacts investors' confidence in the debt. But the US government believes it has a solution to this problem: a cryptocurrency reset, which they think could completely stop this phenomenon and potentially even reverse it, allowing the US government to continue spending with no consequence. To understand exactly what this big crypto reset actually is, we need to look closer at the government interest rates. This is the 10-year government interest rate, which is the benchmark for government bonds that most investors pay attention to, and it currently stands at around 4%, which means that anyone holding a 10-year government bond to maturity receives a 4% interest payment on it for 10 years. This interest rate essentially determines how expensive it is for the government to borrow money. A 4% interest rate is around the historical average of the 10-year government bond. Now, this interest rate is driven by three key forces. Inflation is one of the key factors that is taken into account by investors. Something called the discount rate, which is the short-term interest rate, which is set by the Federal Reserve. And finally, something called the term premium, which is essentially the confidence that investors have in US debt. We can rename this as the risk premium on US debt. Now, you might not have heard of it, but this risk premium is what could cause some real damage in the event of a debt doom loop scenario that we discussed earlier. And this is at the heart of the US government's plan. You can think of this risk premium basically as the added bonus interest on top of the other two factors. If investors have a high level of confidence in the stability of the debt, you're going to have a low term premium that allows the government to borrow at a cheaper rate. This term premium can even go negative. For instance, in 2019, it was at minus 1.5%. So confidence in US debt in 2019 was unbelievably high, and this allowed the government to borrow money at a cheaper rate and also making it easier to pay off its prior debt. If investor confidence is low, however, you're going to have a higher risk premium. And historically, we've seen it go as high as 5% in the US. Typically, this only happens during periods of high uncertainty when there are big geopolitical risks or the government is spending recklessly. For example, the risk premium on Greek bonds in 2010 at the heart of the European debt crisis was above 15%. The historical average of the risk premium in the US is around 2%. Today, this is what the risk premium or the term premium looks like on a 10-year US government bond going back to the 1960s. The historical average is around 2%. Today, that risk premium is at 0%. So this is potentially a major risk that could cause government interest rates to jump higher if investors suddenly decide that US debt is becoming risky. If the risk premium were to just come back to its historical average of 2%, that would make today's 4% government interest rate jump up to 6%, which would have disastrous consequences on the government's budget, but would also impact things like mortgage rates and borrowing costs for businesses, which would probably be the nail in the coffin that finally pushes the US economy into a recession. This is obviously something that the government wants to avoid. So this is where their crypto reset fits in. You see, between 2000 and 2024, the US dollar represented at the very least 60% of global reserves. This strong international confidence has been key to keeping a lid on that at risk premium despite quite high levels of government spending. And that was still the case until very recently. Just in 2023, we were still at 61% of international reserves denominated in US dollars. But over the course of the last year, things have been shifting quickly. Today, we're below 60% and dropping rapidly. One of the big driving forces behind this is that major foreign holders of US debt, like China and Japan, are selling. Both China and Japan were huge buyers of US treasuries between 2000 and 2022 and have recently turned into net sellers of US treasuries just in the last couple of years. This is a phenomenon that the US government has zero control over, but they are trying to potentially offset it through crypto. This is the market cap of stablecoins. These are digital dollars for anyone who wants to have an easier time transacting in US dollars without needing to pass through a bank. These stablecoins also have faster transaction times and lower fees. The market cap of stablecoins is now roughly $200 billion, having doubled from just 2 years ago. The reason that these are relevant is because in order for a stablecoin to be in circulation, it needs to be backed by a real US dollar. In other words, companies that supply stablecoins like Tether and Circle need to purchase US treasuries in order to provide stablecoins. So higher demand for stablecoins means higher demand for dollars. This is something the government understands and has recently passed legislation in order to regulate the sector and promote its growth. The only question is whether this plan can actually have a significant impact on US debt. So let's take a look at that. Tether and Circle are already among the world's largest holders of US Treasury assets, with comparable holdings to Norway and Brazil's government. But this is a market that is growing incredibly quickly. The US Treasury Secretary Scott Bessent believes that a $2 trillion market cap for stablecoins is a reasonable estimate. That would make stablecoin companies the world's largest holder of US Treasuries, with larger holdings than both Japan and China's governments combined. This would completely offset any reduction in US Treasury holdings that these governments might do. And this $2 trillion estimate has been validated by third parties like Standard Chartered that believes 2/3 of this growth will come from individuals in emerging markets, which is something that we are already seeing today, with Latin America, Sub-Saharan Africa, and Eastern Asia witnessing 30% year-over-year growth rates in their stablecoin activity. These are parts of the world that are notoriously susceptible to having unstable monetary systems, and stablecoins provide individuals with access to somewhat of a stable currency, the US dollar. So stablecoins could indeed be a way for the US government to maintain the US dollar's global reserve status through individuals in rapidly growing emerging markets that are simply seeking a better medium of exchange, and so offsetting the deterioration of confidence that foreign governments like Japan and China have in the US. But this entire plan does have huge limits. Foreign investors only account for about 24% of all holders of US debt. Remember, the national debt now stands at over $35 trillion, and it's growing rapidly. So even if stablecoins were to grow to a $2 trillion market, this would only represent a fraction of the total debt pile. So yes, the government's crypto plan is a good one, but it's only going to have a positive effect on interest rates if it is accompanied by a sound government budget. If the government continues to spend recklessly, you're going to see more capital flow away from US treasuries and into assets like gold and Bitcoin that have been benefiting from the loss of confidence in US debt. And unfortunately, we don't think this theme is over. Gold has been on one of its strongest rallies in history, which is a clear sign from financial markets that currency debasement is taking place and that investors no longer believe that the dollar and dollar-denominated debt are an attractive investment. We've been long on gold at Bravos Research since 2023, riding almost the entirety of this bull market with our clients. And although we did recently sell all of our precious metal holdings because it is getting overextended, this is a part of the market that we're going to continue seeking exposure to over the coming months and even years. If you want to follow all of our trades and our exact macroeconomic strategy every step of the way, make sure you become a client at bravosresearch.com. Thank you for watching.